Brad Williams, Frugal Finance, estimating the cost of equity. Having estimated the risk-free rates, the risk premium, and the betas, we now estimate the expected return from investing in equity at any company. In the CAPM, this expected return can be shown as expected return is equal to risk-free rate plus beta times the expected risk premium. If the rate on a long-term government bond were the risk-free rate, the historical, fundamental, or accounting betas would be the beta, and the implied premium or historical premium would be the risk premium. The expected return on an equity investment in a company, given its risk, has key implications for both equity investors in the company and the manager owners of the company. It is the rate at which equity investors must earn a return on their investment in a company's equity in exchange for the risk that they've assumed upon assessing a stock. If they discover they are unable to produce this return, they will not purchase it. If, on the other hand, they discover they can earn a larger return, they will proceed with the investment. For business managers and owners, the return that investors require to break even on their equity investment is the return that they must provide to prevent impatience and disgruntled investors. In other words, it becomes the rate that they have to beat in terms of returns on their equity investments in individual projects. Thus, this is the cost of equity to the firm. Estimating the cost of equity. To estimate the cost of equity for capital construction, we will use the beta of 0.98 estimated from 1.8 together with the risk-free rate and risk premium from the United States. Cost of equity is equal to 1.29 plus 0.98 times 4.31 equals 5.51. This equity risk premium today is 3.97. I just checked, and that's what the latest is. So this number is going to be 8%. What did I say it was? 3.98%. Today's cost of equity is 8.2% for capital construction. I think that will be low because we're going to probably make some adjustments. For the most recent implied equity risk premiums, go to this website. Inherent in the use of betas as a measure of risk is the assumption is that the marginal investor in equity is a well-diversified investor. Although this is a defensible assumption when evaluating publicly traded companies, it turns out to be much more difficult to validate for private firms. The owner of a private firm usually has the majority of his or her wealth tied up in the business. Therefore, he or she carries virtually the total risk in the business rather than just the marginal risk. Thus, for a business like capital construction, the beta that we have estimated at 0.98, leading to a cost of equity of 5.51%, will understate the risk carried by the owner. There are possible three answers to this problem. Suppose that the business is managed with the short-term goal of selling it to a larger publicly traded company. In this example, it's okay to use the market beta and the cost of equity that comes with it. Add a premium to the cost of equity to show the elevated risk created by the owner's failure to diversify. This could help explain the excessive returns that a number of venture capitalists demand on their equity investment in fledgling businesses. Change the beta to show the total risk rather than market risk. This change is rather simple because the R-squared of the regression measures the proportion of the variance that is market risk. Dividing the market beta by the square root of the R-squared, which yields the correlation coefficient, yields a total beta. In the capital construction example, the regression for the comparable firm against the market index have an average correlation with the market of 35.56%. The average R-square was 59.63. The total beta for capital construction can then be computed as follows. Total beta is equal to market beta divided by correlation with the market. I computed it at 2.8. Using this total levered beta, 2.77 times 1 plus 1 minus 2.5 times 0.25 is equal to 3.29. Would yield a much higher and more realistic estimate of the cost of equity. Cost of equity is going to equal 1.29. It's going to be really high because I'm going to adjust that to 3.89 plus 3.29. This is the total levered beta times 4.31% equals 15.47. The 3.9 to 431 gives us 15.47. Now, if I change this to 3.89, you're going to see 18.07%. That is the cost of equity to capital construction. If they're using 75% equity on this project, their hurdle rate is 18.07%. I detailed in length about how a lender is going to evaluate capital construction. Capital construction needs to do their own evaluation. They need a certain rate of return in order to continue growing their business. They need to make 18.07% on their equity in order to grow. I'm going to change this back for simplicity. This is their hurdle rate. This is their cost of equity. Private businesses will generally have much higher cost of equity than their publicly traded counterparts with diversified investors. Although a lot of them eventually give in by selling to publicly traded competitors or going public, a few companies elect to remain private and succeed. To do so, they must diversify on their own, as many family-run businesses in Asia and Latin America have done, or acknowledge the lower value as a cost paid for retaining total control. I know the numbers seem a little odd in terms of understanding. If their cost of equity is at a certain level and your return on equity is lower, you can stay in business. Here's the bottom line. If you're planning on breaking your back for 30 years, you want to pay off. You want to be able to sell your company. And it doesn't take long to do this. I have a spreadsheet and I can evaluate your company in 10 minutes. It's just a summary overview, but it doesn't take me very long in order to do this. And then I can manipulate the numbers. And within an hour, I know how to negotiate what I think the value is. From a private owner's perspective, you're just going to drop and you're going to go, no way. I've busted my butt for 30 years and you're saying my company's only worth this? And I'm going to say, yes, I'm going to support it by all these numbers. And you're going to be confused and your head's going to spin and you're going to go, this is baloney. No, it's not. It's finance. And that's why if you're going to stay in business long term, you need to select your projects. And it's tough. The only advantage you have, you do some unique stuff. But the fact that there's so many private companies within the construction industry that you can pick and choose who you want to do business with. Where you could possibly increase your return is getting in and doing the public sector business. That alone requires just a level of patience and understanding because you're dealing with the government. Moving from the cost of equity to the cost of capital, equity is clearly a vital and essential ingredient of the financial mix for every business, but it is only one ingredient. Nearly all public businesses finance some or a good deal of their operations with debt or some mix of equity and debt. The cost of using these financing sources are generally quite different from the cost of equity. Therefore, the minimum acceptable hurdle rate for a project will reflect their cost as well in a proportion to their use in the financing mix. Intuitively, the cost of capital is the weighted average of the cost of different mix of financing, including debt, equity, and hybrid securities used by a company to fund their day-to-day operations. Brad Williams, Frugal Finance. Thanks for watching.